Good morning. A very warm welcome to the autumn series of Financial Fitness Fridays. I believe that you can hear me. Would somebody just satisfy me, just let me know on the chat box that I sound loud and clear. That will be excellent. Okay, so let's get going. Yay, you can hear me, brilliant. Thank you, everybody. Okay, so many of you getting so many yeses. Great. Well, look, my name's Darren Laverty. Thanks very much for jumping on the Financial Fitness Fridays. For those of you that didn't see our summer series we did of this, it was kind of born in lockdown, born out of the sort of Joe Wicks kind of idea, where Joe Wicks was online getting people fit. We thought, let's get people financially fit. And the key thing here is that in order to be financially fit, really, we just need to have more confidence and take more control. And so today's session, we know that the financial education can be a bit dry, and I think people are getting a bit fed up of webinars, with lots of slides and technical stuff. So we've made this a bit different. It's going to be a live kind of talk show. I've got a great guest speaker called Nikos Christoforou. I don't know how to pronounce his surname. He'll have to do that when we introduce him. And it's going to last for 30 minutes. It's going to be a hard stop at 30 minutes, okay? But along the journey, what I'd like everyone to do, if you can ask your questions, and if you want to stay around after half an hour, we'll end it because I know people have blocked out half an hour in their calendars. They've got other meetings to go to, etc. But for those of you that can stay on, we'll keep it open for another 15 minutes and we'll go through some of the questions that have been coming in along the way. I won't answer the questions as we go through because I want to try and keep this to time. I've got some preset questions for Nikos anyway, and I know that some of you would have been on the pensions Financial Fitness Friday from last time, so just a bit of a recap from that. We're going to come at it from a slightly different angle this time, and it's really, everything has a focus around financial well-being, and we know that financial well-being, it underpins psychological and emotional, mental well-being. It also underpins physical well-being, because without having your money tidied up and having your money in order and in control, it's very difficult to focus on those other things. So again, the theme today is pensions. So what we covered last time, we gave you an idea of how much you need to save. We talked about how to obtain a state pension forecast, and that's important because for a lot of people, that's going to be one of the greatest assets, believe it or not, if we've still got it in the future. We talked about setting objectives and the importance of that, and we're going to go into that in a bit more detail today, because I think that's the most important aspect of retirement planning. And we also touched on the types of investments. And so what I want to do is get Nikos to share with us his kind of view on that as well. And then the other thing I'm going to say, that there's no selling at the end of this, right? So there's no product or proposition or service or anything like that, okay? You can just relax and enjoy and hopefully get some really good, powerful information you can take away and improve your own financial future and your financial well-being. Absolutely. So there's none of that going on whatsoever. Just relax and enjoy. Just take on board the financial wisdom that hopefully Nikos will share with us. So I'm going to just start off with really just a bit of a setup, really, and that is that I think that the most important thing is to understand retirement planning. It has completely changed in the last few years. I mean, I've been doing this for 31 years, but one thing remains the same. In all that time, there's one thing that remains the same. It's going to be quite a theme today, and that is to start with the end in mind. We've got to kind of set a goal. And I know for a lot of young people, they're saying, well, it's so far out, I can't even imagine, for a moment what it needs to look like. Well, I can tell you now, I've been persuading people to save money towards their retirement for 31 years, and every single one of them can't do it without having an objective, having a plan, because you've got to set a goal if you want to achieve it. So even if it's difficult, we've got to spend a bit of time there. We can adjust it over time, but we need to get pointing in the right direction. And what you need as individuals, we all need a strong enough reason why. So someone's asked me a question: how are you sharing the slides at the end? Yeah, we can. Okay, so I'm going to stop. I'm going to take the questions down, actually, because they're distracting me. So I'll leave them till the end. Okay, so the key thing is, I've got another one come up here. Let me just have a quick look at that. I hope it's not one of my team. No, good. Okay, right, I'm going to shut them down. Okay, so the key thing is we've got to start with anyone. We've got to try to set some kind of goal. And I'll tell you why this is so important, because retirement planning, success in retirement planning is like success in anything. 80% of it is psychology. So you can go and learn everything there is to know about pensions. you can become an expert. But if you haven't got a goal with it, you haven't got the motivation, then you don't take action. You know, there's lots of pensions experts out there that are not going to have a very good retirement. So the key thing is setting our objective and understanding our own big why. Okay, so 80% of retirement planning, the success of it is psychological. 20% is the other bits, the mechanics, the technicalities, and all those bits and pieces. But my industry is full of great people, really well-meaning people, but what they tend to do is they tend to focus on the mechanics. They try to prove to people why they should save lots of money towards their retirement. But the key thing is we need to focus on their why, what's in it for them. But retirement planning has changed. It shifted a lot in the last few years, and the key thing is it shifted from the responsibility of an employer and the state. It's now moved to the responsibility of us as individuals. So I just want to share something with you because it's got a bit complicated of late. I want to try to show you how we can take the complex and make it much more straightforward. So I've got some slides here. I want to show you how retirement planning has changed. Now, what used to happen in the old days, we would take what was called an annuity. It was a regular income from our pension pot. We'd buy an annuity. That's kind of changed in the last 10 years. We're now at a place where we can have flexible withdrawals from our pension. We can take as much or as little as we like from age 55. And while that sounds great, you've got a lot more freedom, the danger is, are we going to run out of money too soon? You know, and in the ideal world, what we'll do, we'll bounce our last check the day we die. Okay. The other thing is that we have multiple retirement income sources. Now, I'm guessing, like, you know, nowadays people change jobs a lot during their working life. So as you can see on there, we've got a combination of pensions, a number of different pensions. Some of you might have had a final salary pension. Some of you might be using ISAs and savings as a way of creating retirement income. Most of us won't just be relying on a pension. Most of us will have lots of other retirement income sources. Some people might even take money out of their house. You might have other investments. You might go part-time and sort of enter retirement slowly over a period of time. We've also got a state pension. Here's the problem. There's so many ways we're going to have retirement income. Is how can any ordinary person be expected to manage all of those things in the optimum way? We want it to last as long as possible, to have as much income as possible, and if we died a bit early, to have as much left to pass on to the family as possible. It's a complicated thing, and we need to try to make it simple. So I want to simplify it with you, and then we'll introduce our guest. So the way it can be simplified is this. I want you to imagine you could look into a crystal ball right now, and you could see a whole financial future mapped out visually. How powerful would that be for financial well-being? Because a couple of things goes on. Number one, if it looks good, tick the box, you can relax for now. Everything's okay, you're on track. That's great for financial well-being. But what about if there's a problem? You can see a problem. Say 20 years down the line, you can see actually you're going to start to run out of money. That's still good for your financial well-being because you've got 20 years to do something about it. So we can't lose with this. We've got to be brave. There are ways of doing that. I'm going to show you one of them. This is a piece of software called Void that financial planners use. And it shows somebody here as an example. They're age 45 and they're retired at 65. And the red area there represents what they want at retirement. Into this bit of software comes all of their different retirement income sources. We've got state pension, final salary pension, the current pension at work, maybe an ISA, and it starts to fill out that area of red, which is where they want to get to. That bold black line from the middle to the top right, that represents what they want as an income at retirement. So key thing is here, this person's got a lot of red. They need to do something. There's a gap there, and they can start to see that they're going to have an impact on their lifestyle at age 69. And the good news is they've got 20 years to do something about it. What can they do? They can save more, invest more, consolidate, reduce costs, all sorts of things, change their retirement objectives. Lots of things. Everybody's different. Everybody's outcome there is very different. And this is where skilled operators required. But in this example, what this individual did, they moved their retirement forward a couple of years. Now the red becomes much more manageable. They've got to get out of the red. The red means they've run out of money. So now this bit of software can work out how much needs to be saved to get out the red, to have that great retirement and have everything that you want. But the key thing is that bold black line and the age you go, those two things are the most important thing to get right. Okay, or even if it's not 100% perfect because you're so young, to get pointing in the right direction. So most people's cash flow forecast ends up looking a bit more like this, because they've got different assets and they're going to draw it in different ways. That last one was a kind of simplistic one to help you get the concept. So that is very powerful. So Oh, jumped ahead, don't need that one. Right, okay, so what I'm going to do now, I want to introduce Nikos. Nikos, are you there?
Hey Darren, how's it going?
Hey, welcome, mate. How are you? You
Yeah,
good?
it's Christoforou, by the way. You did well. You did well.
Oh, thank you very much. Oh, you've even got your own condenser mic. Well done.
Yeah, I try. I've got to keep up with the setup.
Did you buy that just for today?
Well, yeah, it's an important day, isn't it?
So are you ready for the questions we've got for the audience?
Yeah, go for it. I'll do my best to add some value.
Brilliant. Okay, as I say, everybody out there, if you've got questions, put them down there now, and then at the end, when we cut off, we'll endeavour to answer those afterwards. And we'll answer ones that are relevant for the audience rather than for you individually. So, question for you then, Nikos, is you use that kind of software with your clients, don't you? So,
Yeah.
can you describe a little bit more, because I rushed it a bit, how you help your clients with that kind of software?
Yeah, no problem. So I think in essence, the simplest way of explaining that software is it puts the plan into pictures, right? And it helps you visually understand what elements are needed for you to get to the end outcome. But as you rightly said, the first thing that I do with every client that I speak with, or that I've dealt with, is to help them define, what that plan needs to look like in terms of really, no matter where you are in life, whether you're pre-retirement or post-retirement, there are going to be eventualities that happen that either pull money into your life or take money out of your life. And what we need to get very good at is to understand when those eventualities are coming and what that inflow or outflow of capital looks like, so that we can then see what impact that's going to have later on when you're actually needing to survive from the funds that you've accrued throughout your working life. So the way that I help people using Voyant or cash flow modeling, there's loads of different types of cash flow models, is really to first define, okay, what does the ideal outcome look like? And believe it or not, that's where I spend the most time, because most people don't necessarily understand what the ideal outcome looks like. They have very vague, I'd like this to happen, or I'd like to be financially free, or I'd like to be able to do whatever, and depending on what they then say will depend on how we navigate the plan. But really what we can then do is we can look at, okay, where are you now? What assets do you have? What's your ability to save? And what's your current, how are you saving that money at the moment? So that I can show them, firstly, if you carry on doing what you're going to do, here's what it will look like. And we can sort of show them the trajectory of how life will look to move, so that we can then ascertain and understand where are the risks to their plan. Is it that by saving money in cash, they're not getting enough of accrual to be able to fill the voids later on? Is it that actually they've accrued some savings and they're buying another house, so actually they're going to get rid of all of those savings and that's going to have an impact later on? Is it that, actually they don't really understand what's going on under the bonnets of some of the pensions that they've got, so actually we don't really know how they're going to grow over time and we can't really forecast? And also we can use Voyant or cash flow modeling to, once we have the ideal plan, so once I can then go, okay, this is what life looks like at the moment. If we was to do this, save this, we was to consolidate your pensions and invest it like this, this is what the changes would be. Or we can start putting through to them strategies as to, and showing them the impact that each decision or strategy makes. And then I think what becomes quite important at that stage is, once you can see that actually I'm safe, what you can then do to add an extra layer is you can stress test it. So you can start to say, well, that's assuming markets do this over a period of time and you accrue this. What happens if 5 years before I retire, the market, there's a COVID, there's a coronavirus and the market halves? How does that impact me? And really, we can then start to get a real handle on what does risk really mean to me, and help people become very comfortable with the level of risk they either need to take or want to take. Because most people try and shoot the lights out and they want 10, 20%. And realistically, most people just need 3 to 5% per annum net after costs to achieve what they want, if they've structured it in the right way, because tax plays a big part.
Okay, so I think there's something in there which I can see that is kind of invisible, but I think it's the real power behind it. When we talk about starting with the end in mind, I think it's really important to spend as much time to get that as accurate and own it. what is that, and that's what's the absolute latest age, what is the lifestyle we want, really design that up well and get it strong.
Yeah.
Because when you use something like Voyant, see, I'm not into the technical side of it like you, it's far too complex for me, but when I can suddenly see that there's my expectation and there's my reality, we need that, because that is an emotional moment. Human beings make emotional decisions. If we want to change our savings habits, we need something to give us that impetus. And I know this from 31 years of doing that, the most people don't save enough because they haven't got a good enough reason to.
100%.
This is how you get the good reason to. The other stuff's important, but it's that without all that information is relevant without the motivation. But the other thing about Voyant is it's a fantastic bit of kit, but I've tried it many times with different people, and it's almost impossible to use if you're not skilled at it, if you're not trained at it. So that normally needs to come with a really skilled financial planner. And a lot of people can't afford them, Nikos. So is there any other ways that they could get a cash flow forecast that's much more affordable?
Yeah, of course. There's always alternative options. You know, I'll give you an example. And this example I'm going to give, I've got no like vested interest. I don't have any shares in it, or, you know, there's no benefit for me saying this. It's just purely for the audience. But, you know, there's firms like a company called Hatch, for example. And Hatch is like a halfway house. So between having like that full advisory service and, you know, bells and whistles, and having a simplistic platform that helps people outline and identify short, medium and long-term goals, and then put like a high-level strategy in place. I believe they offer it for like £249 a year. The first session is free, and then you get annual reviews if you're enrolled for that premium. But obviously you can also pay that monthly. So it works out that it's about £20 or £21 a month to have that cash flow in place that you can sort of check against. That's brilliant, mate. Thank you very much. So now,
So I think we've got a couple of solutions there. People can afford advisors, great. Those at car, they've got Hatch, which is really good. So we touched on this a little bit last time in the previous session in the summer, and I just think it's always good. People always want to know more about this, you know, and it's the investment side. Now, everyone thinks, you know, it is the most important thing, and I actually don't believe that. I think the most important thing is the amount of time you're in the market, when you start early, get your contributions right, and investments are important. But, you know, I think starting early and getting in and having a reasonable contribution from the start, it's going to have a much bigger impact. However, everybody wants to know about investment. So from your perspective, how important is it to have the investment element of your pension set up appropriately and correctly? And how can people go about it?
I mean, this is an interesting one, really, because in short, it's very important, but at the right time, because in my experience of dealing with clients, people often approach this with the wrong mindset. You know, understanding what your investment strategy will look like is very important, but it's actually not the first place you should start. People, you know, most people, when they fixate on what they should be doing with their money, they tend to focus on two elements: the cost of something and the performance of something. And whilst both of those are important factors, they're not the be all and end all. You know, the approach I urge people to take is very much like you've alluded to, is to first start with the end in mind. You really want to first define what is the ideal outcome that you want for that particular vehicle, pot of money or plan, and why you want it. Which, as I said, that in itself can be very difficult, and that's why people seek stewardship from good financial planners. But you see, once you have an idea for the outcome that you want, the next thing to understand is what vehicles or products or tax wrappers will I need in place to help me achieve it. You know, there are a variety of investment vehicles that all have very different tax treatments, that when you understand and you put these vehicles together in the right order, can really make achieving the outcomes a lot easier because of the tax efficiencies. But in the same token, if there is a lack of understanding, or they get the wrong products in the wrong order, they can make it a real uphill battle and inadvertently screw themselves a little bit.
So what's the bottom line in terms of keeping it simple, rather, because that feels like they're going to need to have some really expensive guidance there. But this is something simple that people can do, you know, with their investments. Most people are going to be in an employer-sponsored pension scheme. What should they do? What should they look for?
Okay, well, you know, a good example would be, it really depends on how active the person wants to be in managing money. Right, that's the first thing you need to look at, because if you're someone who wants to get in the weeds of it, then fine. But really a good example would be a fund range. And there's loads out there, and I'm happy to give examples if regulations allow. But there's, you really want a fund range where you can choose the concentration of equity, right? So there are fund ranges where you can pick between 20 to 100% of the fund to be invested in equities.
Okay, so hang on. What's equity? Tell people.
Equity is effectively you're buying it's actually funds more so now, but your equity in essence is you're buying stock. So for example, Vodafone is a company. I'm not saying buy Vodafone, don't go and buy Vodafone. This is not what this is. It's giving an example. But if I want to own a part of Vodafone, I can buy stock in Vodafone. I can invest £10,000 and I own £10,000 worth of that company. And if it goes up in value, my £10,000 goes up with that equivalent amount. If it goes down in value, my £10,000 goes down.
That's called equity.
Yes.
Yeah. So it's the percentage of the fund which is invested in that type of investment.
Exactly that.
Right. Brilliant.
The other side of it will be bonds or debt, which ultimately for the audience again is you have two types of debt. You've got corporate and government. Really, what you're saying there is, hey, if I lend money to this firm or this government, they're going to pay me an interest for that yield. Typically, the safer the credit rating, the less the yield. The more riskier the credit rating, the higher the yield, because there's more chance that they can't pay you.
I expect there'll be a lot of that going on in the next couple of decades.
Yeah, well, yeah.
The billions we're plowing into furlough and stuff like that. Okay, well, look, that's brilliant. I'm just conscious of time. I want to make sure we don't overrun. So we've got quite a lot of questions. But I wanted to just, from the last one, we had a lot of questions which I looked at. People getting confused with some of the jargon. So can we just get jargon busting for people? Can you put a couple of things into plain English?
Yeah.
Okay, number one, a lifestyle glide path.
Okay, cool. So ultimately, this is like, there's a few things this is called, another way of this being pronounced is like a lifestyle strategy, lifestyling. Basically, what happens here is your fund, as you get older, will move more securely. So it will change the weighting between how much equity you hold and how much debt you hold. So the older you get, the more debt you'll tend to hold versus equity, because that's deemed more secure in terms of price movements. If I look at equity and I look at bonds and I look at the price movements of these both of these assets, equity tends to move more like this. Bonds tend to move more like this because it's not an asset that's traded in that way. So what tends to happen is if I'm 20 in a lifestyle or a guide path, my equity concentration might be 100%. So it's like this. But then as I get to 50, 60, actually it'll go from 100% to maybe 10%. So based on age.
That you're protecting the downside risk. As you get to retirement, you start to want to draw that income down. So you're just reducing your exposure. Yeah.
Exactly that.
Okay, another question then. This is a word which is used a lot. I'm sure a lot of people get confused about it. What is a SIP, and do we really need one?
Good question. So
SIP.
A SIP stands for self-invested pension plan. So in essence, it's just a type of pension. There are many different types of pensions across the universe. A SIP has its own pros and cons. So the difference between, say, a SIP and a work scheme pension or another personal pension would just be the assets, the underlying assets it allows you to invest in. You can just do a little bit more. So a SIP allows you to do things like borrow against the value of your pension to buy something like, other assets. There are a variety of things you can invest in that, a normal pension, quote unquote, wouldn't allow you to invest in, such as derivatives, commodities.
You're getting too technical now, mate.
Oh, sorry.
You're losing me. We haven't got on time, unfortunately, derivatives. Okay, thanks for that. So there's something out there that we hear a lot about called tapered annual allowance. What is that?
Okay, so it was brought in 6th of April 2016 by the government to basically say if you're a higher earner and you're earning over a certain amount of money, the amount that you're allowed to contribute into a pension goes down, right? So at the moment, the way the budget has recently moved is every £2 that you earn over £240,000, your pension allowance decreases. So every £2 over 240, your pension allowance decreases by £1. So to give you an example, just hypothetically speaking, most people can put in £40,000 into a pension, right? If you earn, say, 250,000, you're £10,000 over the tapered annual allowance, so your pension allowance decreases by 5,000.
So
right?
what a pension allowance? What does that mean to somebody?
A pension allowance is the amount that you're allowed to put in a pension that is tax efficient.
So if you put more than that in, what happens?
Well, you can put more than that in. There'll just be an annual allowance charge. So you'll get a 45% tax charge on the excess that you put in.
Okay, brilliant. Now, again, that doesn't affect most people. You have to be a massive earner, but it's just a word. So anyone that's earning less than £240,000, you can probably relax. The other bit of jargon, we hear about something called carry forward.
Yeah.
What's carry forward?
Carry forward is a rule that allows you to put in scoop up your unused pension allowance from the previous 3 tax years and including this tax year. All right. So as I was sort of saying, most people can put in £40,000 into a pension, right? So that's this tax year, which is 2021. If we look back over the previous 3 tax years, so 19, well, here we go. Yeah, it's on the slide. So you've got 17, 18, 18, 19, 19, 20, and 2021. You can effectively put in your 2021 unused pension contribution, right? And then you can go back the 3 previous tax years and scoop up or utilize the unused pension contributions from those tax years and get tax relief on the full amount.
Brilliant.
Does that make sense?
Yep. And that little slide kind of says, the thing is there, if you've got that situation, you need to go and get some professional help with that.
100%.
Yeah, so I'm just looking at the time. How are we doing? Good. Okay, so just very quickly before we wrap up and then go to questions, someone like you, this is not here to promote the services of Nikos or Foster Nova. This is here to share your wisdom, and you've done a great job of that so far. And hopefully you can do another 15 minutes of it, Nikos. But some people, do need advisors. They need to go and find one. How can they go about finding one? But also, how can people pay for advice? Because it seems so expensive.
Okay. Well, I mean, firstly, I would challenge your view on expensive, but that's a different conversation.
Yeah, I know you're going to go value for money. I know all that. I know people are better to pay for advice, but they've still got to write a check out, and they've got to find one. So how do they find one?
So let's do it in 2 parts. I mean, look, when there are places you can go to get advisors. So I'll give you an example of a website. There's an unbiased.com that you can go to, and you can search by your postcode to see what advisors are nearby. But there are other ways you can also do it, like ask friends. If you go to some of your friends that have gone through this process, they'll often tell you how the process was for them and if that person is trustworthy for them to deal with you. All you really want to make sure is just that you understand the advisor that you're engaging with, because there are different types of advice. There are advisors that are tied in the advice that they can give, meaning they can give you advice, but only on this specific kind of product that they sell. So you really want to make sure if you're going to get advice, the advice that you're paying for advice and not paying for a product that they sell. That's really key. And in terms of paying for it, so other than writing a check out, as you said, you can use something called advisor charging from the products. So I'll give you an example. Say I advise someone, I tell you what, I've done this recently. So I had a client, we consolidated a load of pensions, and the fee, he wanted to pay the fee from his pension pot. So as opposed to him writing the check out from his bank account, the pensions pay for the fee, which actually is a little bit more tax efficient.
So that's called advisor charging, and most pensions can facilitate that if people cannot afford to write a check out. So a great option. It does give much more outreach to people that necessarily can't afford it, but but sometimes it gets a bit complicated and they're going to need professional help. So it's not the sort of thing people should be trying to do on their own. That's brilliant, Nikos. Thank you very much. I'm just going to share screen one more time. Let me know. I've shut my slides down. Let me find them again. So just while I'm wrapping up, so thanks very much for jumping on, everybody. We do have another session next week running. I'll give my slides, I'll just open them up. Apologies for this. We've got questions to come, got loads of questions, goodness me. Right, okay. So
get excited and close the slides down.
I did. Right, so can you see those slides there?
I can't at the moment.
Okay, let me just do a screen share. Okay.
Yeah.
You see that okay?
Yeah.
So that's next week's session. This is the, we're going to go deeper dive into investment strategies. We talked about savings and investments last time. And this time we're going to go a little bit deeper, a bit more of a guide to investing. So people did want more information. Last time it was more about habits and behaviors, getting us the reasons why, getting us motivated to do these sort of things. So thanks very much, Nikos. Just 3 takeaways, I think. Can you confirm if I'm right on this? Number 1, start with the end in mind.
Yep.
And a few questions have come up. People saying, oh, how it's difficult. I would say, just pick a number into the future, which would be the absolute latest you could ever imagine working till. Pick that date for now. And then look at in today's money, how much you would, what would be the absolute minimum you could live on in today's money if you had to? That will be your starting point. If you're going to get on target for that, then we can work on that. So that's number 1, start with the end in mind. Number 2, get a cash flow forecast. If you can't afford Voyant with an advisor, you've got Hatch. I'm sure there's some other good ones out there, much more affordable ones. And the third thing is, if you can, go and find some advisors. And this isn't us promoting, Nikos. There's a website called unbiased.co.uk. You can put your details in there, postcode. We'll give you a couple of advisors to talk to. You can have a chat with them, and they'll quote you at the end of that phone call what it's going to cost you. Okay, so there's options out there for everybody. So thanks very much, Nikos, for helping us out. I'm now going to anyone that's done for the half an hour. I've just overrun a wee bit. I'm sorry about that. We are a few minutes over, 3 minutes, but sorry about that. But it was too much to cram in. I'm now going to relax a little bit, and I'm going to open up to questions. So I'm going to shut the slides down now. Is there another? Oh, we've got to show you that one. I'm sure my team have been sending me loads of messages to put that one up. There we go. Keeps the regulator happy. Right. Okay. So I'm going to stop sharing. I'm going to look at questions. We have got so many. Right. And you're going to be put on the spot a bit here, Nikos, because you're not prepared for these ones.
Go for it.
Okay. My good, somebody's got nothing to do with pensions and investments. There's a question that a couple of people have mentioned. This is all about defined contribution, group personal pension type pensions. There's people on here that are in final salary schemes. Yep. What advice have you got for them?
Okay, so final salaries is a technical it's a technical area because you need to seek specialist advice from anyone that you need a specific advisor that has the ability to give you that guidance. It's a very high risk area for an advisor to take on because ultimately you've got a pension that's guaranteeing you a certain amount of income at a certain date for a specific period of time. So you really need to seek a specialist advisor to give you that guidance, and that's not something that you can just do quite lightly. I'd really encourage somebody to look around, make sure that they find the right person that has that specific advice that can that specialist advice that they can give that.
Brilliant. Okay, thank you. So I'm trying to pick questions which are going to be more relevant for the group.
Yep.
What have we got here? So someone said, what about a SAS as opposed to a SIP? Just explain in like 30 seconds what that.
Yeah, a SAS and a SIP are extremely they're very, very similar. They've just got slightly different rules. So a SAS is ultimately like a company pension. Like it's like you can as a company owner, what we could do if I had a company joint with Darren, me and Darren could effectively amalgamate our pensions into a SAS and leverage both of our pension pots together, where a SIP is much more for an individual. A SAS is also for companies that there's like administrators, there's like a limit. I think it's 12 people that have to administer a SAS. Basically, in simple terms, a SAS is there's a lot more work that needs to be done because you need to administer your own trust around the pension, where most pension providers now and SIP providers have that trust framework set up around the pension already. So there's a lot more reporting. There's a lot more burden of things for you to do as an individual for a SAS, and they're a little bit more outdated nowadays. So yeah, it's just you just want to make sure you're doing your research around how much you're going to have to do for SASs.
Okay, brilliant. Now there's quite a few questions coming, and this is always a popular topic because people change jobs quite a bit. Consolidation. What's the best thing to do with a number of small pensions I've got from different jobs in the past? I know you can consolidate them in some way. Or can I add to my current pension scheme with my employer? So about 3 questions in one there.
Okay. So again, without giving any advice, or when you're looking at the pensions, the first thing we want to ascertain is, okay, if you've got 5 pensions, one is going to be better than the other four. So what we need to first do is define which one of your pensions is the best scheme. And we'll do that by looking at, or someone will do that by looking at, the death benefits, the fund range and capabilities, the costs, the options at retirement, and, what type of scheme it is. Because if one of those pensions is better than the other four, then it makes sense to consolidate to that pension. Whether that's your current work scheme or not is for either yourself or an advisor to guide you on. But you really just want to find out what's the best structure first, right? And then you want to consolidate to that pension potentially, if that makes sense for you and what's going on. And that's the way I would look to play that. Did I miss anything there? Was there anything else?
I think that's good. That's good. So I've got a question here. Someone's saying that if you set goals for people, you're not putting them under pressure to try and achieve those goals, those retirement planning goals. Well, I could sort of answer that to a degree, because that's becoming much back to the psychological side of things. Yeah. We've got to set realistic goals. I mean, you cannot hit a target you haven't set. And, setting some kind of goal, even if it's a mammoth task, we've got to do something. We can't just wander aimlessly into retirement and hope for the best. Yeah. The responsibility of retirement is solely with us as individuals now. It's not with our employer anymore. They just pay in a fixed amount, pretty much. Unless you're lucky enough to be in a civil service fund, salary pension, but those things are going to be under threat for sure because the aging population. But the responsibility lies with individuals now, and so I think it's about setting realistic goals. If the goal that somebody's trying to achieve is not realistic because it means they've got to save too much, then change it. Move it a bit later. But it does help us focus mind, and people always seem to be able to find the extra money when it's important enough, but without that objective being set, they can't find that way. So I think, yes, sometimes it's, but in the main, when you do some cash flow modeling and you look at different multiple retirement income sources, in the main, most people, it turns out it's actually easier than they imagined.
Yeah.
Not harder. It's easier.
Also,
to add the pension pot. Sorry,
also to add on to it as well, when everybody's thinking like so far ahead, but sometimes when you set a plan and say, for example, you start saving a bit more to your pension and you see that actually, I'm actually making some tax savings here. There are little carrots along the way that help motivate you to continue doing these things. And different people are motivated by different elements to it, right? A lot of the younger clients that I've dealt with are much more motivated by, I just want to be optimum. I just want to recoup as much of my money as I can. And I feel good about putting money into different things and seeing it all work. Where other people, like Darren is saying, are more focused on, hey, I need to really think about later on, how am I going to stop work? So it really depends on where you're at. But speaking with someone will always give you that certainty you need.
Okay, so another question here. Can you give a high-level formula of how to calculate the percentage of salary monthly, which you pay into a pension monthly, taking into account the age you start paying in, providing you want your lifestyle to stay the same?
I would say there's not a generic formula. I mean, there's loads of different theories of savings. Is it Warren Buffett or Jim Rohn who says, you should take 30% of what you can save, put 10% into savings, 10% into investments, and 10% into entrepreneurial ideas. There's no fixed formula. If there was, a financial advisor probably wouldn't really exist, if I'm honest with you. It's much more about, hey, where are you right now? What events are coming on your landscape within the next 5 to 10 years? And how can we navigate what you've got already to get that optimized? And then where are we adding to it? It's much more about getting your house in order before starting to look at just plowing, right? You want to make sure that what you're saving into is beneficial. It's going to add value. It's not going to detract from you. So I would more go along that lines.
Yeah. Okay, brilliant. So I've got quite a few people asking about, can we have the slides? Is there a recording of this? And yes, there is a recording. It's being recorded right now. I can see the little red light flashing away there. So it will be hosted on the Fossa De Novo YouTube channel. Okay, the Fossa De Novo YouTube channel, and it'll be there probably in a day or two. I think the team might better back me up on this if they put a little thing on the chat. I think they'll let everybody know that attended when it's there. So we'll pop an email out and a link to you all.
Quick one, Daz. I just see a question from Alistair. I don't know if this is a good one to help. He says, how can I decide if it's better for me to increase my pension contribution or put money into a stocks and shares ISA? I mean, yeah. I mean, the first thing you want to ask, from a tax perspective, it's potentially better to put money into your pension, right? Because whatever you put into a pension, you're getting a minimum of 20% tax relief on it. So that's an imminent risk-free return, right? Versus if you put money into a stocks and shares ISA, it's for a different thing. If you need, potentially you're going to want access to the money within 5-10 years, and you can't afford to tie it up in a pension until retirement, then you potentially want to look at a stocks and shares ISA as a more viable solution. But if you're looking at how can I get the biggest bang for my buck, you potentially want to lean on the pension side, because you're going to get the imminent tax relief, and then that's going to get invested and grown, hopefully tax-free, which will compound over a period of time.
Just worth mentioning as well, language is a scary thing. And so when it goes back to the psychology of financial well-being, on some of the savings and investment tutorials, ISAs are mentioned, like we touched on today. They can form part of someone's retirement income for sure. But the thing about ISAs in the UK, we're kind of predominantly a bunch of savers in cash, and most people with an ISA, you ask them why they did an ISA, they say because it grows tax-free. But actually, the same people are pretty much investing in cash. And cash, the Bank of England base rate is 0.1% at the moment. Yeah. So tax relief on very little growth is pretty much irrelevant.
Especially when you factor in inflation.
Yeah, I think inflation eats it away. If you look at the last 10 years, pretty much it's been eaten up by inflation. It's going down in value. That's a risk, Yeah. And what I think there is, within an ISA, there's another option, which is the stocks and shares ISA. But I think the wording, the language is what scares people. And without the confidence to make that jump, it feels like they're going from something really safe and secure to something really risky. But stocks and shares ISA isn't necessarily just a stocks and shares ISA. It can be very similar to your pension fund, that type of risk investment. Let's call it an investment ISA rather than a stock and shares ISA. I just want to put that one out because it is quite an important point, which a lot of people pick up on. And a lot of people have actually, on the back of these sessions, gone and had a look at their ISAs and then considered moving it into the stock and shares element of it. Okay, any more questions on this? I didn't look at the Q&A because of this chat, there's Q&A, so I'm looking at two things here. So there's lots of very personal questions here. There's some that are too technical that we wouldn't want to influence people down the wrong road, so like buying property for pension and all that sort of thing. Okay, here's an interesting one. So I've had a probably rubbish, in brackets, pension since I was 22. Good for you. Whoever that is, you are anonymous on here. I've always gone for a maximum contribution that my employer will match, i.e. 5 or 8. However, I think my pot is invested in the lowest risk, therefore it's barely grown. So I don't know, I won't have enough to retire. I'm 40 next year. How can I invest it for greater gains?
Okay. I mean, it's a very difficult question to answer. This is not a simplistic answer, right? Because it's like, that's the golden question. If everybody could go, hey, how can I invest this to get the greater gains, then we'd all be market geniuses. Ultimately, you really just want to look at it and go, firstly, it depends if this is still an active employer pension or not. So if you're still active in this pension, then you want to potentially look at what other options are within the scheme. If it's not an active employer pension, you potentially want to look at, hey, are you actively contributing to another one right now that it makes sense to consolidate to and then redo the investment on that? If you really want to take the option of, hey, I just want to manage this myself, you want to look at understanding, the difference between investments. So what is a passive investment versus an active investment, and how can I comprise a portfolio that's blended between passive and active that I'm happy with the allocation, right? The fourth option is, hey, honestly, go and find someone that can speak to you, because that type of question is not something you can just take in isolation. You have to look at that in context of where you're at and what other assets you've got, and why you, like you've said there, I won't have enough money to retire on. Well, what is enough money? Like, have you defined that, and what's the gap? So it's quite a difficult question to answer. There's no one-stop shop answer there.
Yeah, there's two more questions here, which I think are great, and we're running out of time, but I'm going to put them out. If people have to go, they have to go, but I think those that can hang on, these are a couple of good questions. This one's a brilliant question, actually. And this just proves why you need a skilled operator here. We're looking at the Voyant graphs. The graphs of expenditure into retirement always show ever-increasing expenditure, but in reality, expenditure in the earliest retirement is always going to be greater than later on, because you're healthy and you can travel, holidays and all that sort of thing. So after about 80, it'll slow down. It'll be less. So you need less money. Do you agree? And should the graphs represent this?
Again, it depends on your objectives, right? You say after 80, it will slow down. My question is, will it? because there are other things to then factor in potentially. Like, you know, some people want to factor in, what if I have to send my husband to a care home, or if I want to go to a care home? That's another cost. But potentially it does slow down after 80. But then there are other things to consider, like, hey, do I want to leave my family anything? Is that important to me? You know, it really depends on your personal objectives, but it's being able to first open the dialogue with someone that can navigate you through some of the options or how other people operate, to give you some idea of, well, actually at that age, these are some of the things that would be important to me.
Okay, so just on that note, so if somebody, what their objective was to then have a, you know, reduce their expenditure as they go older, can they do that and then target for that?
Yes.
Great. Okay, brilliant. And one final question, and there's tons still coming in. Wish I could be here for hours in doing it. Just started my first job at age 24. My work pension is non-contributory. So go from your previous answers, I should definitely contribute to it, question mark. Do you have any savings tips for a young person?
Yeah, I mean, outside of it, if you're talking about outside of a pension, by all means, look at, just honestly, if you're a young guy, or a girl, you just want to open up either have your pension or an ISA, a stocks and shares ISA, and potentially just put a small amount of money, a regular amount, and put it in a passive investment tracker. So you don't have to think about the funds, you don't have to think about managing the money. It just tracks the global markets, because facts show over a sustained period of time in the market is better than timing the market. So you just want to have money that's constantly working over a period of time, that you're investing monthly amounts and you're taking different prices over a period of time. Equity as an asset class has outperformed cash, has outperformed pretty much everything. Not to say it will always do that, and I'm not saying, hey, like, this is definitive advice, but I'm just saying, as a savings tip versus just putting money in cash that's potentially going to lose against inflation, having something like that in a stocks and shares ISA would be a good place to start.
Okay, I've got one more question. I'm going to ask it because I think it's useful for people. What happens if you contribute more than your lifetime allowance, 1.07 million? What happens to that money above that?
Well, if you haven't got protection, because you can or could have applied for protection at a higher level where you could have benchmarked 1.25 or more. But anyway, if it's over the lifetime allowance, then it's a tax charge once you've crystallized it. So the 55%.
Oh, painful. So
yeah,
basically, you overfunded your pension pot to that degree, you could be paying 55% of it in tax. Yes. So again, if you're tracking that, you know, go and get some advice. It's going to be worth it.
Definitely.
Okay, I think we're going to end it there. And I know there's still questions coming in. We'll try to pick some of these up individually. There's so many, I didn't realise how many we're going to stimulate today. But thank you, everybody, for jumping on. Please come along next week, support us with the investment strategies one. We're going to do this over the whole autumn. Then we'll have a couple of months off. We'll do it in the spring, we'll do summer. We'll keep on going like that. Thanks very much for supporting us. I hope that you all have a great journey to your own financial well-being. Good luck with that. And as we say, you know, if you can afford to talk to a professional, go and do that. Go to unbiased.com. You can find somebody on there. Maybe if you can't afford a voyant and an advisor, try Hatch Out as a £20 a month solution. Definitely get you pointing down the right road. Thank you, Nikos, and thank you to Second Sight and Foster de Novo for providing all support for putting all this on. I've got millions of thank yous coming through. That's brilliant. Take care. Have a great weekend, guys, and I hope to see as many of you as we can next week, next Friday, Financial Fitness Fridays, 11 o'clock. Thanks, Nikos. Take care. Have a great weekend, everybody.
See you later. Thank you.
Bye. See ya.